We just need to find something bearish to talk about. Oh, I know. How about earnings? Let's talk about potentially the first signs of EPS weakness as macro momentum cools. Actually, that's just a straight up title from Bank of America Securities here. Let's try to understand what they're complaining about here in essentially this 2-page report complaining about earnings per share weakness. Stock 600 12-month forward EPS level has reached an all-time high in June, helped by the rebound in global growth. That's forward earnings per share, all-time new high in June. Great. Stock's 12-month forward EPS expectations earlier this month hit an all-time high of 37.5 euros, following a 6% rise from the January low. The key driver in the upward revisions to EPS was a sharp rebound in global growth since May. Where's the weakness then? Because so far, that's pretty good, right? Rebound in global growth since Q4 of 2022. Global PMIs rising by 6 points since December to a 14-month high of 54 in May. At a sector level, upgrades were largely driven by banks, which have accounted for 40% of the rise since January. What is this? Yet the latest data points to a renewed rollover in EPS, most likely in response to the weakening euro area macro momentum. After a period of strong upgrades, Stock 600 12-month forward EPS expectations have recently started seeing renewed downgrades, likely due to a weakening in the Eurozone momentum. Euro area PMIs down 4 points since April, so in other words, sort of peaking out in April, and a recent surprise is hitting a 3-year low. Now, consensus EPS expectations fading, with 2023 Stock 600 EPS growth falling to a new low of 0%. Boy, it really feels like they're writing a piece here out of both sides of their mouth, because on one hand, it's like, look how great everything is. Oh, but recently things are weakening again. Why would these things be weakening? And maybe is there a chart that can help us show this? Spoiler, yes, there is. We're going to talk about that. We see scope for weakening in earnings outlook to intensify in response to deteriorating global growth. So let's understand this. If we're looking at deteriorating global growth momentum and this potential further weakening, then you could end up seeing more of an earnings recession in Europe. And so I want to see, how does this look chart-wise, and how's their stock market reacting to this? So, and why is this happening? Well, they argue that A, more tightening coming, especially with tighter credit conditions and the lags that we've been expecting. Although we've been talking about lags for like a year and a half now, and it just feels like it's taking forever to actually show up. B, the likely fading of tailwinds that have offset credit-related growth. This would be like your excess savings that basically let you spend through a tighter economic period. And ultimately, a fading of some of that stronger fiscal support that you've gotten in the US and the Euro area. So, what does this look like chart-wise? Well, here it is. These are the expectations going forward. If we look at EPS growth and sales growth, we get the numbers here. The first one I think that's worth looking at is the 2023 EPS growth and the 2023 sales growth. So those are going to be your blue lines, not your grays. So go over here. You've got EPS growth essentially turning to negative. You could see some of the recovery you had briefly coming out of last year. This was sort of your uptrend in January, February, although we've recently trended right back down. And so this is really representative of flat earnings per share growth. This would be your EPS growth. This would be your sales growth, but with higher costs, you're basically at zero growth in earnings. Now, what's remarkable is, even though these numbers are so low for 2023, 2024 sales growth is just here. But look at the explosion expected in earnings per share growth for next year. So even though we might be flat on EPS for 2023, if you get out of the stock market now because you're worried about 2023 earnings, you're missing what could be 7 to 10% EPS growth next year, which is remarkable. That's really good growth. As a result, what is something like the DAX doing in Germany? Well, even though it's near all-time highs, it's basically just chilling out near all-time highs and trading sideways, which is not bad. I would not mind that at all. If you go back at the max look at the DAX, you can basically see we hit all-time new highs. We're basically at December of 2021 levels for the Germany stock market, and they're worried about a 2023 EPS decline. Like, this is really all the bears can give us. This horribly bearish news is leaving us with the DAX that's up 10% for the last 6 months. Year to date, up 13%. Year over year, up 28%. 5 years also up 28%. And then out to the max here. I mean, obviously, you can see you're at all-time highs here. So it's kind of neat, though, to see this, because remember our favorite bear, Mr. Mike Wilson over at Morgan Stanley? What does he always say? He always says, hey, EPS recession coming, buckle up. But wait a minute. If you're going to buckle up for the EPS recession, what that's saying is you're wanting to sell because you're worried about those low 2023 numbers on this chart, which again, to make that very, very clear, are these numbers right here. And because you're so worried about those 2023 numbers, you'd be willing to give up these delicious 2024 numbers there in purple. It just doesn't make logical sense. But okay, whatever. What do we have over here? This is the forward EPS look. And sure, you can see some recent decline here in the level of EPS. But, you know, what I think people so frequently forget is look at the trend where we previously were. I want to manipulate that line. I'd like to get something like, no. GoodNotes is being funny. Look at that. I can move the highlighting. I don't want to move the highlighting. I just want to be able to draw a diagonal line. There we go. Here's probably your trend. Or there we go. Let's try to get a little bit of a trend line on what we had previously. There's your previous trend, this purple line. So you're just now barely breaking through this trend. And quite frankly, if you don't look at trend and you just sort of look at this on a nominal basis, what do you find? Well, you find that you're actually still quite a bit above what you previously had in terms of a level of earnings per share. And I think it's easy to forget that we have grown a lot. We're this whole green box above what we were in 2017, 18, 19, which is fantastic. But yeah, some decline, potentially below trend here, and I expect some volatility. But then again, this is also just a scenario. It's not actually what's happened yet. But what's important about this is, if this is what the market is pricing in, this sort of decline, and what if we end up bouncing at trend here? If the market is pricing in that kind of pain, and the stock market's just laughing it off, hey, that's great. Here's another one, forward EPS versus the global composite. New orders, that's the darker blue line, not that important. Over and undershoots of EPS analysis versus inflation. This just gives you an idea of euro area expected headline CPI. You can actually see it's expected to potentially go negative by 2024, which is great, on a 3-month change basis. And then you have the stock 600 forward EPS less the macro hit in the light blue line. All right, not that big of a deal. Some more charts here giving you a little bit of a look at my favorite one here as well on margin projections, just showing you that the markets are basically already assuming that margin growth is going to fall, that sales growth, EPS growth, everything's expected to rotate down. But again, look at what the stock market is actually doing. So I always scratch my head over this. I'm like, man, the bears are so bearish, but the market's already assuming this, and it's still doing well. So where's the surprise? I don't know. Who knows? I think that's where the bears are really relying on some form of a black swan. But in terms of actually seeing something right now, it's tough to find. Tough to find something to be bearish with. So anyway, I always like to cover something bearish every day. I'm a big fan of sharing perspectives. That's exactly what I do in the courses on Building Your Wealth link down below. My goal is to wake you up when it comes to investing in stocks or real estate or making more money as an entrepreneur or self-employed. whether it's understanding how attorneys work, CPAs work, realtors work, how the game is played, how to build your wealth. Guarantee you'll find something in there that changes your perspective and helps you build wealth. So check it out. I'll link that down below. And that's my take on the bear piece. Priced in EPS pain that the stock market just right now doesn't seem to care about. Which, again, also makes intuitive sense, because are you really going to sit out 2023? Because you're so worried about 2023 that you're potentially willing to be mispositioned going into 2024. Because remember, it's not as easy as like sell now and just get back in January 2024. Usually the stock market starts pre-pricing in good news or bad news ahead of time, which means maybe that EPS downgrade is already priced in, whereas the upside of 2024 is just now being priced in. Now, I want you to know this: when it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by